What's up, hungry investors? Welcome back to the channel. Today we're getting granular on commercial real estate. You might be thinking, is the market a confusing mess right now? And to that, I would say not necessarily, because we've got the intel you need with the Q1 2024 market cycle report. This report dives deep into the 5 major commercial asset class types across 54 major MSAs. Think office buildings, warehouses, apartments, shopping centers, and even hotels. Data doesn't lie, and Professor Robert Mueller and his team at the Burns School of Real Estate, they bring the facts. We use this info to forecast future market conditions and help us make informed investment decisions, and that's what I'm hoping you'll do too. But remember, knowledge is power, so do your own research. Ready to unlock the secrets of the commercial real estate market? Stick around to find out more.
You got to be hungry.
The Real Estate Market Cycle Monitor looks at the 5 major commercial asset class types across 54 major metropolitan statistical areas, or MSAs. This report is a lagging report based on true statistical data collected by Professor Robert Mueller at the Burns School of Real Estate. Therefore, this information is best used to help forecast current and future market conditions for making informed investment decisions. However, as with any investment decision, it's best to do your own research and validate your assumptions. Now let's jump into the report. As of the end of Q1 2024, job growth and new stock market highs seem to be propelling steady employment growth, even with high wage inflation. The indications are that the Fed appears to be on pause until they see inflation reduce to close to 2%. But this may take another year, as 30% of the CPI is housing costs, both rental and ownership. And both rents and mortgage interest rates would have to decline to bring inflation down. This is unfortunate because 10-year commercial loans coming due cannot be refinanced at 6%, which would put almost 1,000 banks across the country at the risk of high loan losses. This tells us that both construction and permanent loan financing may be very difficult to find in the near and midterm future. The graph you're currently looking at on the screen is a visual representation of the commercial asset class and where they currently sit in their representative market cycle. Office occupancy declined negative 0.2% in Q1 2024. While rents were up 0.2% for the quarter and were up 0.8% annually. Industrial occupancy declined negative 0.4% in Q1 2024, but rents grew 1.2% for the quarter and were up 4.7% annually. Apartment occupancy decreased negative 0.2% in the first quarter, but rents were up 0.2% for the quarter and up 1% annually. Retail occupancy was flat in the first quarter, and rents grew 0.7% for the quarter and were up 2.8% annually. And last, hotel occupancy increased 0.2% in the first quarter, and average RevPAR, or revenue per available room, grew 1.81 for the quarter and was up 4.1% annually. The Real Estate Market Cycle Monitor analyzes occupancy movements in 4 property types in 54 MSAs. Analyzing these market cycles should enhance the investment decision capabilities for you as an investor or an operator. The 5 property type cycle charts we're about to dive into summarize almost 300 individual models conducted by the research group that puts this report together. And those models analyze occupancy levels and rental growth rates to provide the foundation for long-term investment success. Commercial real estate markets are cyclical due to the lagged relationship between demand and supply for the physical space. The long-term occupancy average is different for each market and each property type, but long-term occupancy average is a key factor for determining rental growth growth rates, a key factor that affects commercial real estate income and therefore investment return. As we move into each individual asset class type and show the graphs, keep this in mind. Cities or markets that have moved since the previous quarter are shown with a plus or a minus symbol next to their name, and the number of positions the market has moved is also shown. For example, a +1, a +2, or -1, -2. Markets don't always go through smooth forward cycle movements, so they can regress or move backward in their cycle position when occupancy levels reverse their usual direction. This can happen when the marginal rate of change in demand increases or declines faster than originally estimated, or if supply growth is stronger or weaker than originally estimated. Okay, let's look at apartments. The national apartment occupancy average declined 0.4% in the first quarter of 24 and was down 1.1% year over year. Demand had a strong rebound in the first quarter with over 100,000 units being absorbed and almost 400,000 units year over year. Unfortunately, net absorption was negative as the apartment market continues to deal with heavy new supply from 150,000 units that came online just in the first quarter. Class B and C rent growth was double that of Class A units, mostly due to little new supply and high occupancies that exist in these lower B and C tiers. Many Sunbelt markets saw rents decline due to extreme amounts of new supply. The national average apartment rent growth was up 0.2% in the first quarter and was up 1% year over year. Make note that the 10 largest apartment markets make up 50% of the total square footage of multifamily space monitored. So the 10 largest apartment markets are in bold italic type to help show you how the weighted national average is affected. Let's dive into retail now. Retail occupancies were flat nationally in the first quarter and were up 1.9% year over year, maintaining its highest peak occupancy in history. Only San Francisco had an occupancy decline. Half of all new demand was driven by startups, discount or off-price brands, and food and beverage tenants. Good locations are hard to find and in high demand, with freestanding retail having the highest occupancy rate. Demand was up 42 million square feet year over year, with 250 million square feet of total leasing. New supply was only 40% below the long-term average, and 155 million square feet of retail has been demolished since the start of COVID, which has further restricted supply. Most new supply was either single-tenant build-to-suit or ground floor space in a mixed-use project. National average retail asking rents were up 0.7% for the quarter and up 2.8% year over year. With retail, the 14 largest markets make up 50% of the total square footage of retail space monitored. And that means the 14 largest retail markets are in bold italic type to help show you how the weighted national average is affected. So despite what you hear about e-commerce killing brick and mortar retail, the statistics are showing that people still want to get out and shop. That's it for this market report. But what do you see happening right now heading into Q3 or even Q4? Join the conversation. Leave a comment below with your thoughts on the current market conditions for your investment type and even in your market or markets that you invest in. If you'd like to read more and download a PDF copy of this report to view all of the market sectors by asset, you can do that by heading over to our website, hungry-inc.com, or you can find the link in the description below. Thanks for joining me for this edition of the Market Cycle Report. I'm Christian Cotta with Hungry Investment. If you enjoyed this video and you want to see more, don't forget to like and subscribe for future commercial real estate insights and information. See you next time and stay hungry, my friends.
You got to be hungry.